My name is Paul Healy, and I'm the CEO of the Property Funds Association. I'd like to welcome you this morning, and I'd like to extend my thanks to ShineWing for hosting today's webinar. I'd like to warmly welcome our members. Thank you for joining us today, and I'd also like to extend a welcome to our non-members. I'd like to thank our speakers who will be introduced in due course, those being Greg Preston and also Milton Cations and Mark Pratt. And I'd like to thank Greg for his paper, which is being discussed today, dealing with valuation uncertainty. And that focuses on the importance of accounting and valuation standards in the COVID-19 economy. I'd now like to introduce our moderator, Rami El-Chalabi, Partner, Assurance and Advisory Services, ShineWing Australia. Rami leads the Assurance and Advisory Services of ShineWing Australia and has over 17 years experience in providing high quality services to his clients. Rami is ShineWing's lead audit partner in property and funds management. He's regularly called on by the PFA to contribute to thought leadership and present insights to our members. Thank you, Rami, for moderating today, and over to you, please.
Thanks, Paul, and good morning, everyone. I'm very excited to moderate today's webinar on what I know is such a hot topic for this sector. I think we've got about 200 people registered to attend today, which I think clearly shows that this topic is of significant interest for those that are working in real estate. I get to introduce today's three speakers, Greg, Milton and Mark. I'll do that prior to their presentations today, and I will moderate the Q&A towards the end of the webinar. Greg will present a summary of the issues paper that Paul mentioned, that Preston Rowe Patterson have prepared, and Milton and Mark will provide some reflections in relation to that. And we plan on finishing today's webinar at midday. A few housekeeping matters before we get going. All attendees are on mute, which we've activated at our end. So if you're on homeschool duty today, feel free to use your mum and dad voice because no one will hear you. Being on mute doesn't mean though that you don't get to ask questions about panelists. We're using the Q&A function, which hopefully you can see at the bottom of your screen. Post your questions throughout today's presentation. Paul and I will collate those and we'll put them to today's speakers either throughout or we'll carry them over to the FAQ session at the end. We're also running live polling today. The poll questions will appear on your screen throughout the webinar and can be accessed at any time using the poll button at the bottom of your screen. Once you answer the question, it will disappear. We'll compile those poll results and share them with you at a later stage. Let's begin. I'll introduce Greg. Greg Preston is the founding director of Preston Rowe Patterson and continues to be a pivotal figure in the growth of that business. Preston Rowe Patterson have 28 offices throughout Australia, 4 in New Zealand, and have a number of strategic partnerships throughout Asia. Greg acts for major REITs, funds, banks, and many others across all classes of real estate. Greg has a degree in commerce, a master's in applied finance, and is a life fellow of the Australian Property Institute and fellow of RICS. He recently won the API Colonial Alfred Clifford Cat Award for services to the property profession. Greg also sits on the executive of the Property Funds Association of Australia. Good morning, Greg, and over to you.
Thank you, Rami, and thank you to Paul as well as the PFA for promoting today's webinar on this very topical thought leadership issue for us all. Sorry, I'm just getting my slides together. Just in leading off, I think it's fairly fundamental that the underlying value of assets underpins economic activity in any given cycle. The circumstances that we're all in the midst of are certainly unprecedented and profound on many fronts. It's from an investment real estate viewpoint, it's creating enormous administrative challenges in terms of dealing with tenants, and the valuation process is also going to be a significant challenge. The we're all in this together. The stakeholders in investment real estate, from the REIT fund managers to trustees and custodians, to tenants, to debt and equity providers. It's certainly something that we're having to grapple with in a very, very short time frame. There's one take out of this that I can almost certainly guarantee is that students of economics are going to be studying what we're eating, living and breathing at the moment for the decades to come. The paper which we've prepared on behalf of PFA is not necessarily the panacea of valuation ideology in this COVID economy, but it's intended to start a robust discussion aimed at uniform platforms and approaches to dealing with the many challenges that face us ahead. There's quite a bit of detail in these slides, and some of it, or a large part of it, has all happened since we wrote the paper over Easter. So I'm not going to sort of dwell on all of the points in the paper, but it will be available on the PFA website this afternoon and for guidance going forward. The topical points are application of valuation and accounting standards in this economy we're in. And I think there is a bit of a saving grace insofar as that much of the standards that we have before us today were developed post the GFC. I'm speaking specifically of AASB 13 fair value and quite a lot of the IVSC's valuation standards and so forth. The COVID economy dates and durations that relate to lease cash flows, rental cash flows, I just want to bring that up after. Talking about the code and its application and how it's been rolled out in states and territories. The immediate need to classify tenant risk based on the nature of the tenant business is a fairly important issue for us all. And then where will the market be absent transactions, and how will we deal with forecasting cash flows, the calculation of capitalisation rates, discounts and so forth. Finishing off with there's a little bit of maths as well about how we are preparing for it. And then just wanted to also touch on the FIRB announcements. The main accounting standards, turning to them in a little more detail now, obviously the fair value standard, property, plant and equipment and investment property. These standards talk of and speak of the need to corroborate valuation approaches and inputs, particularly level 1, 2 and 3 inputs in the AASB fair value standard. But that means taking into account actual incomes and validating discount rates, capitalisation rates. We'll come back to that later in the brief presentation this morning, just in terms of what we're doing with that, and which I think is pretty important. The standards, because they were drafted in the aftermath of the GFC, deal with a lot of the things that we're facing today. And there's some specifics that I've just referred to here, which are articulated in the paper as well, that deal with risk and uncertainty, consideration of rental income or actual incomes, pricing investment property in ASB 140 under current conditions, and so forth. But there's also some very similar and parallel guidance in the IVSC valuation standards, which were printed or reset in January of this year. But I've just got some directions as to where to find those things there. The IVSC has also published a very valuable paper on valuation uncertainty. In fact, it's a very similar paper that was produced in the midst of the GFC. However, it has replaced GFC with COVID-19 economy in its language, but it speaks of dealing with observable inputs to quantitative measures of value and the need for a narrative describing those inputs. I'll later on in the presentation, I'm just going to talk briefly about how we would see benefit in valuations being undertaken at the moment. Some of these opinions are personal opinions, others are things that the PFA perhaps endorse, but we'll just cover that off as well. The dates and durations. Obviously, in valuing any investment property, or indeed if you're undertaking due diligence to acquire something right here today, the dates that these issues have become apparent or been legislated or announced or and so forth, and the duration that they apply is very significant in terms of calculating cash flows. The key dates that we are working with are obviously the Prime Minister announced that the pandemic will become a pandemic on the 27th of February. The WHO announced or declared the pandemic on 11 March and 12 March, depending where you are in the world as the time issues evolved. The JobKeeper thing for real estate is very important in terms of its commencement and expiry date. And I note the expiry date, 27th September, because the commercial leasing code has been bolted on to JobKeeper. We all are familiar with that. The code was announced by the Prime Minister in his update on the 7th of April. And then the things that are uncertain are the length of the pandemic period itself, as well as the reasonable recovery period. Now, both of those time periods in terms of duration are mentioned in the Commonwealth's code and the state iterations of the code, but they're very important in terms of calculating COVID-19 economy cash flows as opposed to lease contract cash flows, which we enjoyed as recently as 6 and 8 and 10 weeks ago. The rollout of the legislative reform in the states and territories to ratify the Commonwealth's code has, as with most real property issues in Australia, whether it be planning, titling, statutory valuation and land tax council rates and so forth, rolled out quite differently in each of the states. My home state is New South Wales, and we've done quite a bit of work looking at the regulation that has been announced on the 24th of April in New South Wales, for example, which deals with regulatory amendment to our Retail Leases Act and our Conveyancing Act. It has been rolled out differently in each of the states, and if you're looking at cross-border investment, it's going to be yet another challenge in dealing with real property law rolling forward. The key code principles, I just wanted to touch on very briefly. We've split them into two, and the numbering on the left is the numbering of the 14 key principles in the Commonwealth's code. But the two sort of categories we've looked at is those that don't impact cash flows, where they just can't terminate leases, no fees and charges are ceased and so forth. So they're not cash flow impacting principles, but those that are these ones in my next slide, where we talk about proportionate deductions in rental relative to trade reduction. We speak of waivers constituting 50% of the reduction. We speak of deferrals being amortised for 24 months, or the balance of a lease term, whichever is the greater. And one of our poll questions deals with this today in terms of deferrals representing an amendment to a lease rent obligation under the lease contract, or in the alternative, an unsecured loan between a landlord and tenant that may, on some interpretation, survive a lease or occupancy by a tenant if the lease expires in the COVID-19 period, recovery period and deferral period. So I think the key things that we have been looking at are the waivers, the deferrals, amendments to outgoings, recoveries, and that's going to be very much dependent on whether the leases are net, semi-gross or gross, but certainly something we need to be thinking about. The next point that I just wanted to bring up, which I've dealt with in the paper, is dealing with the valuation maths, or unnecessary valuation maths with all of this, and we'll get on to some examples in a moment, but I think DCF is the best and most useful approach to valuing assets at the moment when we are comparing the lease contract rents that we enjoyed prior to the onset of COVID-19 and its economic effect relative to those which we might see rolling forward. The challenges are the code has come out on the 7th of April. The states have rolled out their application or ratifying application of the code differently, and we're yet to see negotiated outcomes between landlords and tenants that would allow us to have a thorough and detailed understanding of our forward cash flow. So in some respects, we're in a bit of a hiatus with understanding our cash flows at the moment that we're actually going to achieve. But there's some directives that will guide us to that. But it's certainly going to be a challenge for those on the ground managing property and having to deal with tenant applications for relief under the code and perhaps otherwise. this is a significant issue that has landed in our lap, classifying tenants as to their likelihood of meeting lease contract rents or falling within the code, or indeed negotiating outside the code. But I think that the classifications that we've looked to, we need to understand tenant businesses, because obviously certain businesses have been impacted immediately, others haven't. Having an understanding of government tenant cash flows versus non-government, one would assume that government will honour its lease commitments in rolling forward. Turning to the JobKeeper logic, whether or not a small to medium enterprise has got a greater or less than $50 million turnover, and therefore is eligible for job seeker and therefore eligible to knock on the door regarding the leasing code, is something that's important. If tenants are outside the JobKeeper and therefore leasing code eligibility, what is the likelihood of them seeking rental relief anyway, which is important. Another category is those that may not have slid into JobKeeper territory immediately, but may do in the near future. And then finally, small to medium enterprise tenants that have perhaps gone off a cliff because they have a business that was heavily reliant on not social distancing, like people being on top of each other in a hotel or pub or so forth. So that has an immediate impact. But classification of cash flows, the tenants and so forth, I think is immediately important. The cash flow impacts that we need to be considering is the quantum of any waiver, the duration of the waiver, and the quantum of deferrals, as well as the quantum of the amount of deferment. There's the other sort of less but important issues like statutory outgoings reductions, and how that might in fact impact on net versus semi-gross and gross leases. The freeze on rent increases is also an important consideration, and all these things fall back to the defined period of the medical COVID-19 pandemic, as well as what is referred to in the Commonwealth Code as this reasonable recovery period. The issue of incentives in leases in the form of unexpensed incentives or incentives beyond the date that we're looking at the acquiring the property, valuing it, etc., in the form of rental abatements and rent-free periods, is the code is silent on this, but it's something that we need to have a careful think about, I think, in terms of valuations. But there is some benefit in thinking about the way valuers deal with unexpensed proportions of incentives at a valuation date, in terms of applying a similar logic to adjusting values for the effect of any negotiated rental relief outcomes under the code or otherwise. The logic where the present value of forward incentives is calculated as a capital deduction where the face rents are capitalised or discounted, I think provides a path forward to valuation adjustment because of the waivers as well as the deferrals. Landlord and tenant questionnaires. From a valuation perspective, we need to understand negotiated outcomes as to waivers and or the deferrals. And so there's some fundamental questions at a valuation level that need to be asked. I have seen many, as we all probably have, of these questionnaires coming out from investment property owners, asking a lot more questions about tenants' ability to meet their rental obligations under leases that go to beyond the sort of turnover thresholds into the bottom line impact. The code does allow for that to happen. So I think, but from a valuation point, we need to deal with just the time effects, the duration and so forth. Fully understand that landlords will be asking a lot more questions of tenants to ensure proper eligibility for any relief. Time value of money mass, and this is where I'd just like to sort of move towards finishing up on. In the event of the waivers, obviously we need to know the amount of the waiver, the date it commenced, its duration, and its expiry date. The deferral is important in the context of the amount, the commencement date of the deferral, the duration, and the expiry date. But one of our polling questions does relate to the last dot point on this slide as to whether the deferral is a payment of deferred rent, or if you like, an arrear that is to be repaid, or is it going to be an unsecured loan? The unsecured loan logic does, in my view, promote quite significant conjecture in terms of dealing with real property law as opposed to lending law. To demonstrate the impact of the way we're seeing it at the moment, the application of the code in terms of the pandemic period or the medical pandemic period, a reasonable recovery period, we've looked at some time value of money demonstration charts just in terms of calculating the present value. To do that, we've just selected or assumed a 6-month pandemic period and a 12-month recovery period to demonstrate the logic. It may well be something different. The pandemic, if we're valuing on 30 June and we continue to sort of improve medically with dealing with the virus as we are in this country, it may be that we only deal with the pandemic period through to the 27th of September being the end of JobKeeper. The recovery period, there is some language in the pronouncements from government, Commonwealth government, that it will be ordained by government, but that's not given yet. But the maths for the waiver is simply, and sorry, I preempt this by saying that if we are calculating the pre-COVID economy lease contract rents in the first instance, it would then be appropriate to deduct from that the present value of the foregone rental in the form of a waiver. This also makes two other fundamental assumptions: that rents will return at a similar level in a recovery, and that the process will come out of it as we went into it. It's a separate matter altogether to be considering the impact longer term on market rents in the whole mathematical equation. The deferral is somewhat more complicated in this mathematical application, and if I just look at the bottom right hand corner, the capital deduction against the capitalised lease contract rents in the first instance is simply the present value of the deferred amount, assuming we actually received it, which is this calculation here as well as this diagram here, less the calculation in C, which what we've done here, just to demonstrate the logic again, is assume a 6-month COVID period, 12-month recovery period, and a 24-month deferral period beyond that. So the logic is that you would calculate the PV of the deferred amount back to the end of the COVID-19 recovery period, and then with that capital sum PV it back today, which would represent a deduction against capitalised rents. All very technical, but it's the way that we are contemplating dealing with it. Just to demonstrate that further, again, assuming those time periods which may prove to be otherwise, what we've done here is look at a very simple calculation with $100,000 a year rent, 3.5% fixed increases, and then a 30% reduction in turnover, and half of that being attributed to waiver and half to deferral. So the issue is, what might those cash flows look like? So what we've done here is we've got our rental of $100,000 per annum, happily increasing it to 3.5% increase, which is what we would otherwise get. We then just calculate a net present value at a discount rate over a full-year term for the purpose of acknowledging that everybody values over a 10-year discounted cash flow. Then what the idea is to work out what that cash flow, how would it be adjusted, taking into account any deferrals or waivers for particular tenants. The first thing to note is that our cash flow, we lose our growth in this period here. We then have got to account for the waiver, so we're waiving this amount of rent, and then we're not collecting the deferred amount of rent for the 18 months, but then we collect it after the following period. So we end up with a lost rental growth of $8,900 in our example, and a lost total rent of this amount. But the reason that we've just popped this example together is to just sort of, assuming market rents return and discount rates are dealt with properly, and there's not a double dip of cash flow adjustment and discount rate adjustment, the impact in this example is about 1.54%. So it's just this mathematics, we've dealt with it already in terms of adjusting our capitalisation approaches, and we've got our code writers at the moment busily adjusting our our discounted cash flow logic. Discount rate and cap rate justification, absent sales, is going to be a significant issue for us in exactly the same way as it was in the midst of the GFC. I actually spoke at one of PIR, or Core Properties conferences in the GFC, and suggested what I'm about to run through here, and almost got tarred and feathered and run out of the conference because people didn't agree with it. Since that time, I've actually been involved in a couple of significant transactions in the city here where the logic that I'm just about to mention, we've used in terms of supporting cap rate compression beyond where the market was, because we could see the cost of capital to the entities participating in the market diminishing. So what the logic is that absent sales, it'd be very easy for valuers to just, without any quantitative logic, just adjust cap rates for risk or discount rates for risk. But there is a way of dealing with this, and important to note, since the onset of the economy, we had our last wave of monetary policy reducing the cash rate. We've seen the risk-free rate diminish and also debt rates diminish prior to the onset of the COVID-19 economy. So if we're starved of transactions, to look at a typical entity in the market, their weighted average cost of capital, which follows the logic of Spencer valuation principles, and then sort of take into account the fact that capital will get allocated to acquire assets if the total return from the asset exceeds the cost of capital. There's a path through this calculating the weighted average cost of capital of a typical entity, buyer or seller in the market, to consider the likely discount rate that ought to apply, and also from there, there's also, it can be interpolated as to cap rates and so forth. So the point that I just wanted to make here, I've actually spoken to several auditors about this logic, and given the objectives of both accounting standards and valuation standards to identify or like pathways to value, or to have some science around the calculation, I think it's important. And the other thing just to think about with this too is, given the reductions in rates, the weighted average cost of capital for an entity in the market's probably come off before the COVID-19 economy. It's obviously, it may move around again. Explaining valuations in this time is going to be a significant issue for all of us. Bankers, regulators, auditors are all going to have a heightened requirement to see how we've calculated things. So I think this is just something that we wanted to sort of run up the flagpole. And again, it's all about robust debate and considering these things. But for valuers to properly value something in this environment, to do a but for or prior to onset of COVID-19 economy valuation, and then demonstrate the adjustments because of the COVID-19, now whether they be cash flow adjustments or discount rate adjustments, so that the reader of the report can understand those adjustments, I think is very important. It will be important until we have post-COVID-19 economy onset sales, so that we can properly articulate the difference between yesterday's value and the current or tomorrow's value. Just on a final point, I know that some pronouncements came out of the Treasurer's Office on foreign investment a few days ago. There's been already no advice that the screening thresholds are reduced to a 0 factor under the Act. It may take time for approvals more so than had been anticipated previously, which may affect inbound cash flows into our markets, inbound investment into our markets on a time basis. But you would have to assume that property as an investment class would be open for business in terms of inbound cash, but that will remain to be seen. So the main takeouts from today that we wanted to get across are, look, the paper that was written over Easter, as well as the slides and the evolution of this, is intended not to be the panacea of how to go about things, but it's to start a robust discussion to develop uniform approaches to valuation. Underscore the need for valuers to corroborate and substantiate opinions of rental forecasts, discount rates, cap rates, and ultimately values in this environment. To draw draw attention to the provisions of the accounting standards, valuation standards that deal with asset valuation and recording of asset valuation in entities' accounts at this time. To press the point that until we've got sales in the COVID-19 economy, there's a lot of merit in providing a prior to COVID-19 valuation, as well as one which takes into account cash flow and perhaps discount rate and cap rate adjustments. But the final point is the keeping the standards at hand, the statutes as they have evolved out in the states and the regulation, as well as stimulus pronouncements to hand is almost mission critical at the moment, just in terms of dealing with some of the things we are faced with. There's some references here as we've repeated them in the paper, and also I've left both Paul and my contact details here if anyone wishes to follow or may have a further discussion about it. But just in finishing, we're all reacting to what's going on. We're adapting and evolving with the intent of surviving. There's lots of challenges ahead of us, but it's very important that these discussions are held robustly and with lots of ideas and input. So, Rami, that's pretty much it from me. Thank you very much, and I look forward to fielding some questions.
Thanks very much, Greg, for that that great presentation or summary of your paper. Stay around. We've got the panel session at the end. We've got some questions coming through, so please keep adding them to the Q&A function in Zoom. Can I introduce our next speaker, please, Milton? Milton is the Managing Director and founder of Property Dynamics, a boutique valuation and advisory firm based in Melbourne. Property Dynamics is also a partner firm of the National Valuation Alliance, Oceanic Property Valuations, currently changing names to Civic MJD Australia, which provides valuation services across the country. With over 38 years of valuation and management experience within all sectors of the Australian property market, Milton currently focuses on the provision of strategic property advice for large, diverse organisations and select individual clients. Milton, who holds both a master's degree and a graduate diploma in property, is a past state president and fellow of the API and fellow of RICS. Milton currently serves on the Australian Valuation Standards Committee for the API. Good morning, Milton, over to you.
Sorry about that. First mistake. Yeah, thanks for that. Can I say, first off, I'd like to thank Greg for his excellent and informative issues paper. And obviously a lot more detail provided in the overheads today. So Greg's paper includes specific commentary on the relevant accounting and valuation standards applicable to the valuation methodology. And it clearly asks for the valuation industry to provide a uniform approach to these valuations. The international approach response to the COVID-19 pandemic has been nothing short of incredible. The various government initiatives put in place have been well directed by dealing with health issues and economic ramifications on businesses and people. While we may see a reduction in such measures shortly, many countries have had to cope with mortality and contagion issues that have been dramatically greater than those seen in Australia. So globally, this world of change has led to a world of uncertainty. And in the current Australian situation, there are two crucial factors facing investment property. So the first factor is government regulations. As Greg clearly outlined, there are severe regulations comprising trading restrictions for many businesses and social distancing for the community. And they've been strongly applied or enforced for an uncertain duration. Restricted trading has also meant cash flow issues for tenants and therefore landlords. Some tenants have announced they're not paying rents, and some landlords are disclosing which tenants aren't paying. Even some large good covenant tenants are seeking substantial rent relief. In response, the government have provided a code of conduct for landlords and tenants. A code that ensures the tenant firms which qualify through JobKeeper gain substantial rental support that is provided proportionally by waiver and deferral. Nevertheless, the current environment appears to be causing a breakdown in many landlord and tenant relationships, and it's leading to increasing uncertainty in the investment property marketplace. Potential vacancies and retail closures are of particular concern. So given the unknown duration of these government measures, this results in further uncertainty. The second factor is market sentiment. The current working environment with many staff working from home is also influencing the longer term occupancy demand perspective in the office market. Future tenant demand is under threat. Tenant trading and lease covenant issues, potential tenant demand changes and general marketplace negativity suggest market sentiment is suffering and investment yields are likely softening. From a practical property viewpoint, these impacts will result in a real focus on valuation approaches and the underlying valuation assumptions. With little sales evidence, there will be a greater reliance on discounted cash flow analysis in all valuations, as Greg's already outlined. Apart from the very detailed calculations Greg provided, I think just in general terms, for cash flow assumptions, the most immediate issues relate to tenancy profile and assessing for each tenant potential vacancy, letting up allowances and incentives, and rental growth rates. And the more long-term factors relate to market perspectives in assessing market rents, initial yields, terminal yields, and discount rates. Assessing these assumptions and factors is going to be a real challenge for valuers, and clearly they'll be doing both. They'll be not only changing immediate cash flows, but changing long-term factors, valuation factors as well. In particular, valuers do need to make sure they don't double count by overestimating the market discount for each factor. In this marketplace, valuers also need to respond to auditor and bank expectations, and therefore the valuer-client relationship is crucial. Clients obviously need to provide very clear and detailed instructions, and valuers need to provide detailed valuation explanation and complete value transparency in their reports. So during this current period, clients must have very clear lines of communication with their valuers. To assist the profession, the API and RICS have both recently issued guidelines as to how valuers should deal with valuation uncertainty in the current environment. Their guides encompass valuation disclosure rather than valuation disclaimer, and the general focus is on the market disruption periods, valuation input availability, and the choice of valuation methodology. In summary, the current uncertainty suggests that for investment real estate, the strength of tenancy covenants will be more closely analysed. Financially strong and government tenants will be more highly regarded, and we will see a likely softening in yields and a greater disparity in prime and secondary yields. In addition, valuations will be completed with greater care and consideration, and I suspect, Greg, at a greater cost, and they will be also scrutinised more than ever. How Australia reacts to the government restrictions being lifted and how businesses and staff return to work is crucial for our economy and our property marketplace. Regardless, this new world of uncertainty appears to have brought with it a changed world forever. Thanks, Rami.
Thanks very much, Milton. Moving on to our last panelists for today, and that's Mark Pratt. Mark joined Australian Unity in 2004. As EGM of Property, he's responsible for commercial management and growth of AU's real estate investment management and development businesses. Australian Unity actively manages more than 4.2 billion in commercial property assets, including the listed Australian Unity Office Fund, unlisted funds in healthcare and commercial property, as well as commercial and development debt funding. Prior to his current role, Mark was COO for Australian Unity Wealth and Capital Markets. Mark is on the committee of the Property Funds Association, the Melbourne Racing Club, and he's a former member of the Victorian Division Council of the Property Council of Australia. He also holds a Bachelor of Commerce in Accounting from the University of New South Wales. Mark, for your few cents, please.
Thanks, Rami, and to the most unqualified person of today's presentation, but certainly thanks to Greg and Milton for going through, what is a pretty technical topic, and one that I think we all need to be alive to. So these are comments from a fund management perspective, not from a valuer's perspective. And I think, but all of us on the call will be dealing with valuers, and I think certainly getting an appreciation of the challenges that they are going to face over the next little bit. So I think even though the situation is evolving, planning for, I think more frequent assessments of the valuation of the properties that fund managers own on behalf of investors is something that we should all be considering at the moment. I certainly think the impacts are going to be different based on the type of assets that people hold. Retail, shopping centres, I think with lots of specialties are probably going to obviously be much more challenged than long WALE single tenanted buildings. But I think we'll all have to work through that in our own way. And I think the piece of advice that I would be putting forward is, as fund managers, we all just need to be light on our feet and continuing to assess and adapt to maintain the right value on behalf of our investors. As fund managers, we deliver both income and growth returns to investors. We are going to focus a little bit more time today just on approach to valuation. And I think some of the questions that I've sort of seen there is, how frequent should we be valuing, what are REITs doing, and the like. And so I'll sort of give you a more general view, but certainly the view from Australian Unity. First thing is, I think generally most fund managers have a valuation policy. And generally that is disclosed to investors. So I think if you don't have one, I think it's worthwhile having a look at investing in one or putting one together and disclosing to investors your approach, so there is no surprises around that. And if you're not aware of what you've got, potentially dusting that off is super important at the moment. This all goes to really stakeholder management. And, as Greg and Milton have said, tenant engagement at the moment is very, very important. Whilst there are those tenants that qualify under the code, which those are not really negotiations, they are just factual calculations. As Greg said, there are tenants who do not qualify under the code who will also be seeking to negotiate some form of rental relief. Maybe it's short term or change to their leasing arrangements and the like. So all of those things people need to be alive to. I think being positive and on the front foot and being proactive with your financing partners and with auditors, I also think is absolutely crucial in this time. And that is something that will absolutely flow through to investors in the results that we see coming up to 30 June and in terms of valuation for them. So engaging with your investors around some of this, I think, is positive. And, I think there are a lot of people on this call who are doing that at the moment, and people are completely aware that there are going to be some challenges over the next 6 months. So I don't think there are going to be people are going to be accepting that the pain is being shared right across Australia and the whole sector. So I think just leaning into that is crucially important. We're looking at frequency evaluations. I suppose at Australian Unity, we would have a rolling, with all of our properties are valued once a year on a rolling annual basis. We're reassessing the valuation of all of our assets at the moment, regardless of when they've been revalued, probably with a focus that all of our assets will be revalued, all of our income producing assets will be revalued in the period up to 30 June, or given we manage open-ended funds as well prior to a liquidity facility. I think, look, the valuation approach that people have got to think about is, what does it mean for investor equity? If you have investors coming and going at different times, and ensuring that the NTA is appropriate and correct and represents fair value is absolutely crucial for investor equity. If you have fixed-ended funds or closed-end funds, that may be less of an issue, but ensuring that the NTA is appropriate is absolutely crucial. I think the other thing I would note in this is, depending on where asset goes on some hardship provisions, even if you do have a closed-end fund with limited liquidity, ensuring the NTA is correct is absolutely crucial. Obviously, independent valuations are the best approach. I think they take away all arguments from people. So that would be the preference, I think. Given, someone as experienced as Greg and Milton, as you can see the complexity that goes into that is going to go into the valuation process from experienced professionals. Directors' valuations at the moment, personal opinion, I think, are fraught with danger. But I think something, depending on the asset type that you have, you know, and the confluence of time and value, something that may need to be considered, but potentially as a last resort. The other thing is rotation. In a lot of valuation policies, people have a rotation policy on valuers that, you know, the same person can't value an asset for more than 2 or 3 years in a row. I think just given the current challenges of access and of valuers to assets, new ones, and then also the volume of work that's going to go ahead, potentially consideration of a relaxation of that policy in the short term is something that's worthwhile. I think maybe just touching on, just to close, on a couple of comments the other guys have made. I think with only a slight jest, I think it's refreshing that valuers are talking about making sure that they don't double count. Certainly that's our approach. I think there will certainly be impact to cash flows, deductions, leasing allowances, rental growth. In this period, we've also seen risk-free rates all around the world go even lower, and I think they're probably going to be there for a much longer period now. So the impact on cap rates and discount rates going forward, I think, is one that requires a longer-term consideration, more so than anything else. But that's something to be considered. And I think, you know, it's not all bad news. I think there was a question there about what, you know, could be the impact for long lease tenants. Could the valuation go up because there's a reflection of that cap, the change in bond rates and the like? Well, look, that's certainly a possibility, but one thing that I think we will see evolve over time. So just to bring it to a close, I think this is a time where fund managers need to be very much aware of their disclosure obligations and what it means to ensure investor equity is preserved, depending on whether people can come and go, and working with all of your stakeholders. So on that basis, Rami, I'll hand back to you.
Thanks for that, Mark. Great summary there from a fund manager. Quick reminder for those that haven't answered today's poll questions, please do so. Very eager to get your thoughts on that. Let's move into the Q&A part for about the next 6, 7, 8 minutes or so. Thank you. We've got a number of questions that have come through today. Some I think have been already addressed, some have been touched on. We'll do our best to get through as many as we can. For the ones that we don't get through, we'll look to circulate out some responses to all attendees so everyone has had an opportunity to get some answers. I might start with a very first question starting with Greg. Greg, one of the questions that's come through is regarding, I guess I'd reframe the question regarding structural change. So how likely, or how do you think valuers need to consider the potential for structural change in certain asset classes regarding how people might use real estate? For example, will there be behavioural changes in leasing regarding office tenants, office buildings? Just wanted to get your thoughts on those more structural changes, how they're being considered at the moment.
I guess, Rami, those sorts of things are sort of looking into the future in terms of having a good crystal ball. There's things going on that there's been a lot of anecdotal comment about people living from home, getting used to it, having different impacts on the need for certain classes of space going forward. It's too early to call, I think, is the answer to that. If we were to try to sort of make any sort of quantitative adjustment for that, we can't see it yet. So I think it's something that, yes, it needs to be front of mind, but wait till we see some evidence, I think, of that happening.
Thanks, Greg. Thanks for that summary. I'll ask another question, if that's okay. I might direct this one to you, Mark, in relation to rent reviews, which I imagine are taking up a lot of time. So I guess in terms of rent reviews, how do you think they'll be dealt with? Obviously, the code has provisions in it regarding, no rent reviews. Again, this is perhaps a little bit crystal ball gazing, but what's your sense of how the market will react in terms of future catch-ups on rent increases once the pandemic ends?
Look, I think I don't think it's going to go back to the way it was. I think and whether you've got fixed rent increases or the like is something that we'll need to work through. I think at the moment, look, for us, it's about working with our tenants to ensure they remain tenants in the short term. And I think that's sort of the key focus for us at the minute. And I think tenants are in that mindset at the moment. I think tenants are in a mindset of, okay, what do I do for the short term? And if we can preserve a relationship there, and I think that's certainly our approach, is to preserve relationships with our tenants as best we can, then we will manage those rent review pieces when we get to the end of this. I think if you qualify under the code says what will happen. So that's actually not a negotiation per se. In some respects, it is just a requirement, noting that there'll be different things come through the states. And I think for all tenants who are above 50 million, and, in things that then becomes a negotiation. And our view here is that, look, we're happy to help people out as best we can, but that may have some impact in terms of lease term, how long they're committed to the property, all of those types of things. So, I think at the moment that's how it plays out, to Greg's point, further down the track, I think is something no one's really in a position to make an assessment of at the moment.
Thanks for that, Mark. I might direct this question to Milton to start with, perhaps, and then Greg, you can make some comment regarding DCF. The question is the DCF the right methodology where short-term issues may differ from long-term cash flow situation? Milton, have you got any comments on that?
Yeah, well, I guess we're probably going to have no choice but to deal with direct capitalisation rate valuations as well. But clearly, as Greg and I were saying, you're not going to see a straight cap rate valuation without a cash flow analysis supporting it. So I think we'll see both. I mean, a lot of these factors can be built into the cash flow as well. But look, time's going to tell with a lot of, and we won't be able to do a lot until we get some transactions. Just want to make a brief comment in relation to your question about structural change to Greg. I think we probably won't know a lot about how the office market's going to change till people come back. When the first restrictions start coming off and people come back to the office, that's when we're going to get a better understanding of what's going to happen. In relation to rent reviews, I think also remembering that the rental benefit or reductions being given to tenants are only effectively 50% of reductions in turnovers. So there is an amount that tenants are going to have to pay in the longer term as part of a deferral. So I would think that based on that, it's going to be very difficult for tenants to afford to pay a catch-up amount for rental growth that's, well, not being given at the moment. They're going to be under pressure for quite a while with the extra rent they're going to have to pay as part of a deferral.
Thanks, Milton. Appreciate that. Greg, did you want to make any sort of closing remarks?
Look, just on the DCF issue, I think if you look at the counterfactual, Rami, for a valuer not to attempt to comment on any adjustments to cash flows going forward, they'd be seen a lot less alike than having a reasonable attempt at calculating those cash flows. And just, I think DCF is the way to go, although the time value of money calculations and income capitalisation mirror the logic. But there is guidance in the IVSC manual along the lines of selecting discount rates and so forth, and corroborating assumptions as to the cash flows going forward. So again, better to have a look at how you anticipate they may change rather than ignore the logic of that.
Thanks for your response there, Greg. This question is for you, Mark. With regards to the refinancing of bank debt how are you seeing valuations impacting on, I guess, the availability to either roll facilities? What strategies are you talking to with financiers, potentially if you have any shortfalls, and just probably some more general reflections on the finance market at the moment, please.
There we go. Look, I think we're in a position where, you know, we actually don't. We rolled some finance on our, or extended some tenure on our finance on our listed fund just before COVID broke. So that was, well, very good management by the team. So well done to them. But look, I think, look, where I sort of see this at the moment, I think most REITs, unlisted or listed, are much levered much more conservatively than they were in the GFC. So I think that the need for short-term finance is probably one that is less there, debt finance, in the next little bit than there was in the GFC. So I think that's a bit of a structural difference to where we are. I think, though, what's going to happen is, you know, you've seen in the last 2 days, NAB, ANZ and Westpac either, you know, can write down their profit by 50 or 60%. And I think commercial landlords are going to be ones where, whilst a lot of consumer-related customers are going to get relief, and SME businesses and the like, I'm not quite certain whether commercial landlords, certainly who are funds, may get that, you know, any relief over time. So that may, for some people, become a more pressing matter, but I don't really see it as being a matter at the moment. Pricing has spiked a little bit just with where credit spreads and things are. So access for liquidity for banks over the journey, I think, will be a little bit more of a test, but that is more of a pricing piece, I think, than a necessarily an availability piece. And you saw NAB raise like $3.5 billion in a day the other day as well. So, and there's certainly a lot of liquidity sitting in markets at the minute. If in listed capital markets you want to go and raise some equity. So I think once again that will evolve, but at the moment, you know, the discussions with our banks are, they're sort of pretty, for banks, they're relatively sanguine on where things are. They're alert but not alarmed.
Thanks for that, Mark. We're fastly approaching midday, so unfortunately we don't have any more time for questions. We will look to answer all the questions that have been posted. Before I sort of close, you have another minute or so to answer any poll questions. So if you haven't done that, please click on the polls button at the bottom of your window, and the PFA would very much like to hear what people today feel about those questions. Thank you for everyone in participation in today's webinar. Thank you very much to all the panelists for giving up their time on a topic that I know is going to be the subject of much discussion for everybody over the next 3 to 4 months. If you'd like a copy of the issues paper, you can find that on the PFA's website. And I'm certain for those that have any further questions regarding valuations, you can reach out to Greg or the team at Preston Road Patterson or Milton. I'm sure they would love for that. If you have any other follow-up questions, some of the questions coming through are sort of accounting related or even tax questions, feel free to contact Shining Australia. If you follow our LinkedIn page, we're putting a lot of information out there regarding things like JobKeeper, the mandatory code, and many other various initiatives that support the sector. So before I say goodbye, there is a short survey once the webinar ends that the PFA would like you to complete. So I would please encourage you to do that as soon as we close. Be well, everybody, stay healthy, and thank you very much. See you all very soon.